Hello everyone. Do you remember my friend Mason? Wait, if you don't know him, he recently started his cafe. Alright, I have one small task for you. Can you list out all the things he needed to start his cafe? Don't worry. I will give you some time to think. So, here is the list: building, coffee machine, money, tables and chairs, supplies like coffee powder, milk, light and AC, refrigerators and freezers, and some cooking equipments to make some coffee. You might be thinking why I ask you this question. So let me make it very clear for you. The new topic that we are going to discuss is accounting terms, and it will be easier for you to understand these terms. Mason is the owner of the business. So a person who owns a business is called its proprietor. He contributes the capital to the business with intention of what? Yes, earning the profit. Building, coffee, machine, lights, refrigerator, freezers, these are what? The assets of the business. So you might be thinking, what are the assets? Don't worry, I'll tell you. Assets are the properties of every description that belongs to the business. Yes, these are basically the things that someone owes. So there are basically four types of assets: fixed assets, current assets, fictitious assets, and wasting assets. So first we will discuss the fixed assets. What are fixed assets? Assets which are purchased for purpose of a long-term use are called fixed assets. For example, building. There are basically three types of fixed assets: tangible assets, intangible assets, and long term investments. So, we will discuss these one by one. The first one is tangible asset. Tangible assets are those assets that have some physical existence that can be seen or touched. For example, building. The second type is intangible assets. They do not have any physical existence but give some benefits and rights to the owner. It cannot be seen or touched. For example, goodwill. In simple term, goodwill means the reputation of the business. The third is long term investments. All the businessmen have some extra money, so they invest it in the other businesses. So the next type of asset is fictitious asset. What is fictitious assets? These are basically the imaginary assets which cannot be seen or touched. They do not have any physical form but have some value. They can be valued in terms of money. Example, advertisement expenses. For example, you have 50,000 as advertisement expenses. The advertisement expenses are huge. So what company does is divided into several parts. The remaining part, which is not recovered in the business, is termed as fictitious asset and is shown on the asset side of the balance sheet. Current assets. Current assets are basically the assets which are there with the business for a very short period of time, usually 1 year. For example, debtors and stock. The last type of asset is wasting assets. Assets having very limited time period whose value decreases over time and is also known as consumed asset. For example, natural gas and coal. Let's test your knowledge. You have to classify these assets. Alright, here is the solution. Building is a tangible asset, cash is current asset, debtor is current asset, and patents are intangible assets. Well done if all your answers were correct. Suppose you borrowed some amount from your friend. Now, the money that you have borrowed, you have to repay it. The money that you borrow is called a liability. So, liability refers to the financial obligation of the business. These denote the amount which a business owes to the others. For example, loans taken from the banks or other persons, goods purchased on credit, etc. There are basically three types of liabilities: non current liability, current liability, and contingent liability. Let's discuss these liabilities one by one. The first type of liability is non-current liability. When the funds are available for you for a long period of time and you have to pay it after 5 years or 10 years, that is known as non-current liability. For example, shares, debentures, loans, etc. Current liability. When you have to pay the liability after a very short period of time, usually 1 year, these are known as current liabilities. For example, short-term loans and creditors. The third type of liability is contingent liability. Contingent liability is liability which may have to be paid at a future date depending upon the happening or non happening of a certain event. For example, product warranty. The next term is business transactions. Business transactions are those transactions which involve transfer of money, goods, or services between the two persons. The next term is capital. The amount which is invested by Mason to start his cafe is called the capital. Whenever Mason will withdraw goods or money from the business for its personal use will be called as drawings. Goods are the commodities or articles bought or sold by a businessman with the motive of earning profit. So, guess what will be the goods in case of a cafe? Yes, in case of a cafe, goods will be coffee, muffins, etc. So, money or the goods taken out for personal use is called what? Yes, money or the goods taken out for personal use is called drawings. The next question for you is that the loan that is taken from bank is an example of which type of liability? Correct. Loan taken from bank is an example of non-current liability. Next term that we are going to talk about is stock. Stock include all the goods which are unsold on a particular date. Stock may be opening stock or closing stock. Let's discuss these. The term opening stock means when goods are unsold in the beginning of the accounting period. Similarly, the term closing stock means the goods which are unsold at the end of the accounting period. Opening means beginning, whereas closing means at the end of accounting period. What are purchases? Purchases refers to the amount of goods bought by a business for resale or for use in production. Sometimes we return these goods to the suppliers due to defective quality or the goods are not according to our terms of condition. This is known as purchase return. What are sales basically? Why you produce goods? You produce the goods in order to sell them. So sales refers to the amount of the goods that are already bought or manufactured and is sold. When a customer is not satisfied, maybe due to defective quality or the goods are not according to the terms of sale, they will return it. It is known as sales return or return inward. Every time you don't sell the goods on cash, sometimes you sell the goods on credit. So a person that receives the benefit without giving money is called the debtor. So the person from whom Mason has to receive money will be the debtor of that business. Similarly, a person who gives benefit without receiving money immediately but to claim in the future will be called the creditor of that business. The person to whom Mason has to pay money will be the creditor of the business. Revenue. Revenue means the amount which is receivable or realized from the sale of goods and earning from interest, dividend, commission, etc. Whatever you are receiving. On the other hand, expenses is the amount that you spent in order to produce and sell the goods and services. For example, purchase of raw material, payments of wages, salary, etc. Let's test your knowledge. You have to match the columns. So here is the solution. Expense electricity. Goods returned by customer is called sales return. Sale of good is an example of receipt, and goods returned to supplier is called purchase return. Well done if all your answers were correct. Next term that we are going to talk about is income. What is income basically? Income is the difference between revenue and expense, the amount whichever is left with you after paying off all the expenses. Then what is voucher? Voucher is nothing but a document in support of a transaction. It is a written document basically. It is a proof that a particular transaction has taken place for the value stated in that particular voucher. Then what is receipt? What is difference between voucher and receipt? Receipt is a document that proves that cash is received. It is issued to the party paying cash. Last topic that we are going to talk about is account. What is account? Account is a summary of relevant business transactions at one place relating to a person, expense, or revenue. Every account has two sides, debit side and credit side. What comes under debit side and credit side? Let's discuss. Debit entry means whenever there is increase in asset or expense and decrease in liability. Whereas credit entry means whenever there is decrease in assets or expense and increase in liability. That's all for today, and you know all the terms now. Hit the like button if you like my video and subscribe to my channel to never miss the new updates. Thank you.